Hello and welcome, everybody. Happy Friday. We've made it through another week and we're here with another lesson for you all. One Sectors Made Simple subscriber sent us an email wanting to learn a little bit more about REITs, or Real Estate Investment Trusts. It's an amazingly interesting topic that presents us with some very high reward, but with it high risk opportunities. So I want to go through this all with you today. I want to talk about REITs, where they're good, where the risks start to come in, some alternatives that allow you to get into real estate with a little bit less, or with a little bit more options, but also how you can do research to find what REIT may be the best suited for you. So that's the topic for today. We're talking everything about REITs. Before we get to the presentation, we've got lots of people here with us live that are ready to learn, so want to say hi to everyone that we have with us in the chat. Hello, Emelida, Blaze, Gloria, Josefina, Anna, Lucia, Adelita, Delia, Juan, Gloria, Eddie, Riley, Chela, Pablo, Veronica, Mayra, Karina, Consuelo, Janice, and Omar, and Nancy. Good to see you all. As always, I do need to say, because I will be talking a little bit about taxes and that kind of thing, that the purpose of today's webinar is for educational purposes. I will help to show you the resources as well as the basic information about REITs. However, with everything that we talk about here, please always do your own research prior to making any investment decisions. Trust but verify is very, very important, and that cannot be more overstated than today. So let us get started with real estate investment trusts, or REITs. This is an absolutely awesome topic because they are a very, very deep topic. It's like talking about the stock market, where the first slide may be, what is the stock market? It's that level of deep. So without any further ado, let's get into the usual question of what is an REIT. So an REIT, as I said before, stands for Real Estate Investment Trust. And this isn't an asset class like stocks or bonds are. It operates similar to them though. But again, it's not an asset class. An asset class would be real estate. Real estate is an asset class. It's a type of thing that we can invest in that shares similarities with others. So just like stocks, bonds, commodities, even things that are derivative assets are still an asset class. But REITs is much like mutual funds or ETFs are. It is very, very similar to both of these, where it manages a portfolio of assets on behalf of their shareholders. So people like you and me give them our money and say, hey, I trust you. Go invest this money for me and make me some money. So these REITs, much like funds, some of them are publicly traded on the New York Stock Exchange, the NASDAQ, while others you can only buy over the counter, or you can only buy if you are in kind of in their inner circle. It's closed off to everyone except for institutions. But there are still opportunities to get involved in that institutional investor side, even if you're a normal retail investor like you and me. Danny, bienvenidos a nuestro video. Estamos aquí con una lección de REITs hoy. Pero si quieres aprender más de Sectors Made Simple, tenemos un sitio, sectorsmadesimple.com, y ahí tenemos más de 30 horas de videos como eso, y tenemos videos sobre usar y aprender las cosas del Matrix. Recomiendo que puedes verlo, los videos. Empezar con el primer video de gratis y hasta el video que se llama Making the Matrix. Estos videos van a enseñarte sobre el Matrix y la información que necesitas aprender para usarlo. Jenny, the volume is at 100, but still hearing very low. Please let me know if is it quiet for other people as well? If so, I can turn up the volume. I just don't want it to get too loud. Alrighty, so let's continue on with REITs, and I've got my eye on chat in case the volume needs to go up a little bit. Jose, how can you find your coupon? If you are a member, you can find your coupon by logging into the website and then going to our homepage, sectorsmadesimple.com. You'll see a little ad that says, click here for your coupon. Gracias, Lucia. Estoy practicando mucho. Alrighty. So, how do REITs work? So, REITs are very much like other funds. They collect money from investors and then use this money to invest in various types of real estate or other physical property. So what this means is that they invest in properties. And this is not just things like homes or apartments. This includes data centers, hotels, medical offices, cell towers, warehouses. We're talking anything that occupies land. If you can build it, there's probably an REIT that trades it. And REITs pay out their net earnings as dividends. So they collect all of their profits, and then every so often they'll take those profits and they will give it out to all the shareholders. How much depends on how well they did. And again, these REITs are not like, they're not like mutual funds where, or sorry, they're not like ETFs where you need to pay an expense ratio. Instead, these REITs pay their managers pre-distribution, which means before they put out their dividends, they'll take their cut so that, you know, they got to make a living too. They'll take their cut, and then everything that's left over gets distributed to all of the shareholders. Now, not anyone can start buying and selling property and call that an REIT. There needs to be some things that REITs require. So what this is pretty simple. REITs are required to do the following things. They are required to invest at least 75% of their value in either real estate, cash, or treasuries. So this literally means real estate or cash equivalent markets for all of you that were with us for our asset classes webinar. So that is where most of their money is held. At least 75% is either in in real estate or in money markets that can be quickly turned into cash. Then, this is where we talked about they take out their cut and then the rest they send out to their investors. At least 90% or more of their income needs to be distributed as dividends to the shareholders. Then, you can't have one big person sitting at the top running the show. They need to have a board of directors. The point of the board of directors is to look after the shareholders and to protect the interest of the shareholders. Then, speaking of, they need at least 100 shareholders. This can't just be me and the Sectors Made Simple group investing $1 million into an office building. We need to have at least 100 of you guys coming along with us. So that is another requirement. And then lastly, we need to have no more than 50% of the shares held by 5 or less people. So those 100 people, they need to be involved. They can't just be chiquitico part. Adalita is asking, could you please translate into English or Spanish? Oh, not the webinar. Oh, understood. Okay. So now I've talked a little bit about what it takes to be an REIT, but let's take a step back. Sectors Made Simple talks about stocks and ETFs. Why all of a sudden are we talking about real estate? It's not something that you think about when you say, all right, I've got $500 sitting around and I want to invest it in something. Real estate's not usually your first choice. So why? Why are we talking about real estate here? Well, the answer is pretty simple. Yes, Sectors Made Simple is all about stocks and ETFs, but it also we really operate on the assumption and the premise that there's always a bull market somewhere. Somewhere in the market, there is opportunity for growth. And finding that bull market is very, very important. That's why we have the matrix. It's a very, very easy way to find that bull market when it's in the stock market. However, real estate is not like a sector. It's more like an entire market unto itself. Yes, we have XLRE, but real estate, that's like, instead of just saying XLRE, it's like saying it's the difference between XLRE and the sectors are to the S&P 500, as the S&P 500 is to the market, which means that XLRE is like saying SPY in the real estate world. It's just the broad index of everything. But within real estate, you have rentals, you have data centers, you have mortgages and loans. It's an incredibly, incredibly diverse group of offerings. And due to these number of different options, real estate often has one or more subsectors that are outperforming the market, even in good markets. The returns that real estate can offer at times are incredibly high. We're talking 10 to 25% return in a single year. Also, it's worth noting that real estate has a low, what's called correlation to stocks and bond values. Oh, Mayra, happy birthday. Feliz cumpleaños a ti. So let's look at this again. The word correlation means that the two things, they work very similarly. So, trying to think of a good analogy for this. It's like saying that peanut butter and jelly are very, very correlated. We like them, they taste really good together. So when there's a correlation between two things, if thing A goes up, you would expect thing B to go up as well. Just like if thing A goes down, thing B will also go down. So because of this, real estate, when we say it has a low correlation, that means that stock prices can be going every which way. Real estate doesn't care about the stock market. It doesn't care about the bond market. It does its own thing. It marches to the tune of its own drum. So it's a great opportunity when the market is either volatile, if you're more for the calm kind of market, although real estate is volatile in of itself. But if the market is going down, that doesn't mean that real estate is also going down. There can be a lot of opportunities in real estate regardless of how the market is doing. However, like I said before, real estate oftentimes carries much higher risk, but also much higher reward. But lastly, it also provides an opportunity for portfolio diversification. This idea of don't put all your eggs in one basket. Think about it like this. You can invest in 5 different stocks, but if the market's going down, there's a good chance that all of those stocks are going down. So diversification isn't just investing in multiple companies. It's also investing in multiple asset classes so that if one has a really, really bad day, you're okay. The rest of them might be hanging on and doing just fine. So real estate is this crazy market in of itself, where yes, we look at it as one sector amongst many in sectors made simple. But again, it's like saying XLRE should now be like saying SPY. Yes, it's a single thing that we can look at, but it's an entire market in of itself, and XLRE, in fact, invests in only real estate investment trusts and real estate companies. So XLRE is our benchmark for how real estate is doing on the S&P 500 level. So with that said, let's go into the different types of REITs that exist. I'm clicking on the wrong window. So there's a couple of different types of REITs, and they're all similar in that they manage real estate assets, but they're different in how they actually generate their profits. So equity REITs are what you would usually think about when it comes to buying property. You buy a property, you buy an office building, and then you rent out the office to a company. That company pays you rent. That rent pays your brokers and pays your account managers, and then pays the shareholders. So that's how equity markets work. Income is generated through the rental of properties that are owned by the REIT. Second, we have mortgage REITs. These REITs, yes, they still handle real estate, but a lot of their income comes through lending money for real estate investment. So they say, oh, Juan de los Palotes, you want to buy a house? Here's $1 million to buy your house. You pay us back plus some interest. That's a mortgage REIT. They make their money off of lending money to others to invest in real estate. And then there's hybrid, which does a little bit of column A and a little bit of column B. But to give you an idea of just what percentages we're talking about here, 90% of REITs are equity REITs. 7% are hybrid, 3% are mortgage. So the vast majority of the REITs that you will see will be equity REITs. So the REITs that you will see will be equity. I'm a poet and I didn't even know it. I'll tell you what, that was the one class that I was always terrible at. I was terrible at English. Anyway, we're here to talk about stocks, not how bad my grades were in high school. So, now that you know the three main types of REITs, let's talk about the different ways in which these REITs are traded. The first and most common one, and also the one that will probably make the most sense to all of us retail investors, is the publicly traded REITs. These are represented by ticker symbols like AMT, things like that. And these shares are listed on major exchanges like the NASDAQ or the New York Stock Exchange. And most importantly, they are regulated by the SEC. Then we have the non-traded. So these are still public companies, but they are not traded on major exchanges. Instead, you have to go directly to your broker to buy them, or go directly to the managers and buy it from there. But these are still maintained. These are still regulated by the SEC, So there's some accountability. There's some bookkeeping that they hold true to. So these are still a very, very viable option where there's a lot more choices. It's not just who's listed on the NASDAQ, it's who is legit. And then lastly, private. These are not registered or regulated by the SEC, and this is typically something that you're not going to see very much. These are reserved for institutions. To get involved in some of these REITs, I kid you not, you need to invest at least $1 million, excluding the value of your properties. We're talking big bucks here, all right? So when you have some money, a lot of money, you could get involved with an institution and a private REIT, but for the rest of us, we have something that's still very, very valuable and a very, very large industry. Publicly traded, available on major exchanges, and regulated, as well as on the other side, we have non-traded, so over the counter, but still regulated. Danny, solamente enviamos un email por los webinars del miembros, pero si quieres, podemos enseñarte un email también por los webinars de viernes. Si lo quieres, por favor, mándame un mensaje aquí o a nuestro email de support@sectorsmadesimple.com, y podemos hacer un mailing list por eso. Okay. Now, how do we compare REITs? This is something that's very, very important, because here we have something happened. That's very, very strange. Okay. So now we've talked a little bit about the basics of REITs. It's important for us to now look at what other options we may have, because REITs are one way of getting involved in all of the real estate sector, in the entire market. But we have more options than just that, and we need to look at what our other options are, because, you want to do your research. Trust but verify is very, very important. So for real estate, we have 4 other options that are not just real estate investment trusts. We have real estate ETFs, much like XLRE is. Then we have real estate funds. Real estate funds operate similar to ETFs with some small differences. Then we have investing in real estate directly. And lastly, real estate crowdfunding. Real estate crowdfunding is one of the newest types of investing and has its advantages and disadvantages, just like all of these other options do. But let's step through each one of these alternatives and compare them to REITs. So first up, let's talk about real estate ETFs. These real estate ETFs invest mostly in equity REITs. They do invest in normal real estate companies as well, but if we look at some of their holdings, most of their holdings, it's real estate REITs. And with most index funds, these ETFs track an index. And because of that, they're not trying to make the most money they possibly can. They're just trying to track the industry. So if the industry is doing well, this will do well. If the industry is not doing well, all right, maybe not so great. Regardless, we're not here to see how much money we can make, and there's no one who goes into their office and their only job is to make as much money as they can that day. Many of these ETFs are what is called passively managed, which means that there's no one whose job it is to go in and make trades. It's all done automatically and in an effort to follow the index as closely as they can. Now, much like most ETFs, they do charge an expense ratio, but because of this passive management, it tends to be pretty low. We're talking 0.05% to 0.2% low. Lastly, real estate ETFs, because they're ETFs, they don't retain earnings. So if the REITs in their portfolio pay out dividends, these ETFs give you the dividends in what's called pass-through. So REIT over here, you over here. The distributions, the dividends go to the ETF, and then the ETF gives the dividends to you. So this is a really good option because it's something familiar, and it's something that is still available on an exchange. Otherwise, it wouldn't be called an exchange-traded fund. They update prices throughout the day, like all ETFs do. But most importantly, it is something that you can buy and sell very, very quickly. AKA, it is a very liquid form of investment. This term liquid or illiquidity, so it's a matter of how fast can you turn it to cash. Something that's very liquid can be turned very quickly into cash. Something that's illiquid cannot. And you'll see both options here. So the second one that we have is not an exchange-traded fund, it's just a fund. So real estate funds are mutual funds that focus on investing in real estate companies. However, they also might invest directly into properties. And these investments are not limited to just REITs. They may invest in anything that is real estate related that may make them some money. And these funds can either be passively or actively managed. Because of that, yes, they have expense ratios. Yes, they have different fees that they will charge you. And much like any mutual fund, it's always important to do your research to know what fees they charge you and when they charge you those. If you're interested to learn more about mutual funds and the fees they charge, we do have a webinar on mutual funds that I would recommend taking a look at. But for today, and for the topic of real estate funds, again, they are funds, and because of that, their prices don't update during the day. Their prices only update after the trading day is done. So the market closes, they recalculate their NAV or their net asset value, and then they divide the net asset value by the number of shares, and that's what it costs to get in. Now, unlike REITs that generate a lot of their income through dividends, real estate funds, the value there comes through the increase in share price. So, like a drip, you're not buying a drip because you like the company. You're buying a drip because they pay dividends. They'll pay dividends next quarter, and you know the dividend amount is going to go up. Real estate funds, you're buying into a real estate fund because you expect the share price of that real estate fund to go up. When the price of that real estate fund goes up, you make money. When it doesn't, well, you don't make money. Now, the third option is a crazy one, but is also one that's a lot easier to get started with than you may even realize. And that's investing directly into real estate. Right off the bat, direct investment in real estate requires a ridiculous amount of money to get started, because it means you have enough money to buy a property, pay a down payment on that property, or buy it outright, and you're not expecting to make your money back tomorrow or even the day after that. Revenue here is very, very slow. And direct investment in real estate is very illiquid. It takes months, if not years, to create trades for these different properties. And if the way you're buying and monetizing real estate is you're buying, say, an apartment building and then renting out the apartments, it requires you to maintain the apartments. It requires you to do upkeep and maintenance. It requires paying utility bills. It requires being able to know that you're not going to get that $1 million back tomorrow. You're going to get $2,000 in rent, $2,000 in rent, $2,200 in rent. It's going to trickle back in. So you don't expect it to be you buy it today and sell it next week and make your 10% profit. You're buying and holding for months or years at a time here. But like many things, there are many different ways to invest directly in real estate. One of the most simple and common is rentals. You buy an office or you buy an apartment building and you start renting out the suites. Keep in mind, you now are responsible for being a landlord. And many of us have had plenty of lovely experiences with landlords. It's not an easy job, nor is dealing with a landlord. But then the second part that you can make money using investing in real estate is what's called appreciation. It's not just, I appreciate you. It is the value appreciation. It is your money is worth something today, and then it appreciates to be worth more tomorrow. So this is an example. An example of this is, for example, buying a home and then living in it. You buy a property, you live, or you buy it and you just leave it there, and over time, the neighborhood becomes more desirable, or property values just go up over time, and now what you spent $700,000 on is worth $1.1 million. So that is appreciation. You're not buying it to start renting it out today and getting that passive income. You're buying it so that you can use it or not even use it and then sell it at a later point. Then there is flipping. Flipping involves buying a property, investing money, time, resources into improving that property, and then selling it for more than you bought it. This is probably one of the most common, up there with rentals, when it comes to real estate investing. You'll hear tons of people are home flippers. What they'll do is they'll go around to different neighborhoods. They'll find a house that is, a fixer-upper. It's not in the best condition, or it's in terrible condition, but they don't care. They like where it is, they like the neighborhood, and they think there's money to be made. So they buy the house for $700,000, spend $100,000 to revamp it, put in a new fridge, put in a new stove, put in new floors, maybe knock down a few walls, and then they sell it after that for whatever it's worth. Lastly, there is building. Here, it involves buying a pile of dirt, saying, I think a house would look nice here. So you turn that dirt into a house, and then you sell that house. I want to again highlight something here. Appreciation is something that many people do, but they don't realize. If you buy a home and you live in that home, that's an appreciating value. That's an appreciating investment. Yes, you need a house to live in. Yes, it's nice to own the house you live in. But typically, house prices go up over time. When house prices go up, if you buy and then sell later, if the value of that price has gone up, you have made money even though you've been using that property. So it's a great opportunity, but also one that's a lot easier to do than you may think. Because if you buy the property you live in, as long as you're not paying someone else to live where you are and you own the property you live in, it will start to give you returns when you sell the house. Now, the next option that we have is crowdfunding. Crowdfunding is unproven, is the best word. It is a fairly new idea, and what it is instead of an REIT collecting money, a group or an organization will say, hey, there's this private company that requires $1 million to start investing with them. Give me your $1,000. Hey, Juan, give me your $1,000. And they collect different people's money so that they can then invest in that private fund. That is the idea of crowdfunding real estate. And to say it's risky is almost an understatement. Because these crowdfunded organizations oftentimes invest in non-traded or non-public REITs, these REITs are not regulated by the SEC. Because of that, it is very hard to buy and sell your share of these REITs. So they're very illiquid. It's very difficult to find a buyer to replace you because your money is now invested with someone else who's then giving that money to someone else. It's not like suddenly you can say, hey, I want my money back, and they just pay you out. No. You put in $1,000, $10,000, and you hope that you see the return on that. But cashing out is very hard. Plus, because there's less regulation, because these tend to be a little bit more high risk, high reward, they're riskier. There is more risk in something that is more high risk and high reward. And lastly, many of these crowdfunding sites have investment minimums. Some are as low as $500, while others require $25,000 to even open an account with them. Others may require you to get accredited, which means they want to do some checks to make sure that you are a good investor before they even will take your money. So that's crowdfunding. I think, and this is my personal opinion, I think that crowdfunding is an amazing way to fund many startups and create value and equity for people in companies of all different walks. But for real estate investment trusts, crowdfunding is unproven and is far too risky when there's other options out there that do the exact same thing, but you can cash out faster. You can document their 10, 20 years in the market to see how well they've done. There's historical returns. There's SEC filings. There's information. Crowdfunding doesn't have that. I digress. Crowdfunding is an option, but when you have all of these other choices that provide a lot more legitimacy and many of them are backed by the SEC, there's not many reasons to even get started with crowdfunding. Now, I want to kind of close out this presentation by bringing it all back together. We've talked today about the entire real estate industry. It is a single sector on the dashboard. It is a single sector in the market. But the performance of real estate is completely separate to the performance of the market. The market could be doing great and real estate could be doing terrible, or vice versa. The market is doing terrible, but real estate is doing great. There is little correlation between the value of REITs and the stock market. And instead, real estate value and REIT value is more tied to inflation rates than it is to the stock market. And even then, it's not heavily correlated. Meaning, think about it like this. Yes, if inflation goes up, the property value is going to take off. But you want to know what also takes off? The cost to build that structure, the utility costs to maintain that structure, the maintenance costs to maintain that structure. Costs are also affected by inflation. So while we know that there's little correlation between the value of REITs and the performance of the market, even REIT value compared to inflation rates is questionable. But if you want something to look at to get an idea of overall REIT strength, and you don't want to just look at the price of XLRE, yeah, inflation rates, they're pretty correlated. Danny, don't worry, I've got you on the resource for that. We'll go to that right after I finish up this slide. So, the last thing I want to mention here is all of the different choices you have. REITs, real estate ETFs, real estate funds, direct investment, but that's a lot of money, a lot of time, and a lot of effort. And lastly, crowdfunding. But all of these options will have a couple of things in common. Many of them are high risk and high reward. The exception to that is equity REITs that pay out dividends. The most important thing, if you're considering an REIT for their dividend returns, is that there is a difference between what is called qualified dividends and not qualified dividends, or non-qualified dividends. Qualified dividends are taxed as capital gains. They are taxed much less than revenue is. Not qualified dividends are taxed as income. So again, this depends on the specific REIT, but most REIT dividends are non-qualified dividends, which means that you are taxed more on them than you would if they were capital gains in the form of qualified dividends. Alrighty. Are there any questions on the content that we've covered? Are there any questions on REITs, real estate funds, any of that goodness? If you have a question, feel free to put it in the chat below. Erica's asking, I wish you guys would make the slides available. Unfortunately, I try and keep the slides just to me because it's content that I put a lot of effort into creating, and the minute it gets out there, while it's beneficial to many people, it's also very easy for someone to go in, crop out the Sectors Made Simple logo, and put their company's name on it. Good to see you, Jorge. Thank you so much. I appreciate it. It's always fun getting to cover topics like this. Alrighty, if there are no questions on REITs, let's head over right now to take a look at, oh yeah, you can always watch the video again. Let's go right now and take a look together at some resources that we have for REITs. First and foremost, there is, now this is a crazy website name, REIT.com. Pretty simple. REIT.com has a ton of information, but the most important things that it offers is lots of data on REITs. As well, to answer, whose question was it? To answer Josefina, in other words, we need to keep an eye on the XLRE sector for the near future. So the XLRE sector is like saying SPY, but over here, in REIT indexes, you can get a better idea about the daily US returns, and hey, there's even global returns. So if we click into here, it gives us a nice document with the return values. Now, this is a crazy amount of information, but let's look at what we're actually seeing here. We see a couple of things. Most importantly, the value of the S&P 500, as well as the REITs that are within this sector, or within this group, really. So this is an amazing resource if you want to get super into the return values of these different REITs. Again, this is a topic that is incredibly deep. Remember, REITs and real estate is a market unto itself. So I'm trying to give essentially what is the stock market style presentation today. Oh, good to see you, Kike. I'm glad that you're here regardless. So that is where you can find some of the return values for ETFs. Or sorry, for REITs, my apologies. But if we look into here, we can also find REIT directory. So under investing in REITs, here we have a list of a number of different REITs. In here there are 193. However, in the market, there's quite a bit more than that. But this will give you a pretty good feeling of the different types. So here we can see the different sectors that they offer. There's office, industrial, retail, lodging, residential, timberlands, so on and so forth. Data centers, which is my favorite because I'm a nerd and I like data. Oh, and also mortgage. So all of these are likely revenue. Mortgage is mortgage, to show you how small of a thing it really is. But scrolling down, we get a couple of different pieces of information. We get the actual price that that group is trading at, that REIT is trading at. We also have right here the percent return. Sorry, thought I heard something. We also have the percent return that that specific REIT has given us in 1 year. Again, let's look at this. 265% return. Pretty big. Couple more that are above that. But on the far end of things, let's see what happens if we go to last. Because it seems like these are ordered in terms of return. Hey, I don't want NA. I want to see some other numbers. Show me numbers. 0%? Okay. So there are some REITs that don't make money. So again, this is not some crazy industry that's always making 200% return. Lots of different REITs will be performing differently. For example, we see here retail, lodging and resorts, and infrastructure. Guess what industries have been hit very, very hard by COVID and by the fact that most people are no longer working in offices, are no longer going to hotels and resorts. Instead, they're staying home. So again, this resource offers a large amount of REITs that you can compare to see all different choices that you may have. And this again are just REITs. So you can take this ticker symbol, type it in, ta-da, BHR is traded on the New York Stock Exchange. You can go to Fidelity, TD Ameritrade, whatever you might use, buy that, and it's now something you have in your portfolio. The other thing that REIT.com offers, Lucia is saying, so if it's not earning money, what happens? Do you think it's due to COVID? Again, I'm not an economist, and it's very hard to say exactly what we're seeing because, I mean, look right here. The top returning REIT is lodging and resort REIT. Lodging and resort REIT. Mortgage REIT. Retail, mortgage, lodging and resort. So it's not that the industry is performing poorly. And really, this goes to show that even when the market does poorly, there's still growth opportunities for different REITs in different subsectors of the market. And there's no simple answer, and I wish there was. There is no correlation or little correlation between how the market's doing and how real estate is doing. That's why it's very important to look at things like the total return, but also the daily return, which we find over here in REIT data. But again, that is if you want to get involved in this kind of stuff. And again, if you're going to get involved in it, please do your research. You wouldn't just buy a company because Juan de los Palotes said that it was a great company. You always want to do your own research, check whatever they're saying, and make sure that you agree with it. So again, on REIT.com, under investing in REITs, we have the REIT directory. Then what we also have is list of REIT funds. This is going to give us all of our mutual funds. And because they're mutual funds and because Morningstar is king when it comes to mutual fund information, we get the Morningstar rating for all of these. And along with it, we have the expense ratio, what they charge you. We have their year-to-date performance, 3-year performance, 5-year performance, and how much do you need to invest what's the price of admission, basically? How much money do you need in order to get involved with them? For something like CSDIX, you need a cool $100,000. For others, 0, 0, 0, 0, 0. Oh, hey, retirement. Are REITs a good option for retirement? Great question. The answer is it depends. If it is an REIT that generates its money from dividends, from rentals, then yes, it is a great option in my opinion, because it functions very similarly to a DRIP. You're not buying it because of the value appreciation of the share. You're buying it because it pays you dividends, and it is recurring revenue that you know will be there every single quarter. So it is a lot of these REITs that provide consistent dividends can be a great option for retirement accounts if your retirement account provider allows for it. Now, this is funds and REITs. REIT directory, list of REIT funds. We can also click in here for global real estate. Do we have any information on global real estate? No, just a bunch of fun facts. We don't care about that. What we do care about is what ETFDB can offer us for real estate information. So that is the second and last resource that I want to share with you all. So if we go over here to, I believe it's under Tools, and then ETF Screener. Here what you end up getting is something that many of you are familiar with because I've shown this off in previous webinars. But over here under Real Estate, we can click into Real Estate Broad, and now we get all of our different real estate ETFs. We see here that there's some that invest global, some that invest in US, some that invest in everything real estate, while others only invest in REITs. And what's fascinating is when you look in here and you go to their holdings, you can see what they're holding. And guess what? All of these are REITs that are available on the major indexes and the major exchanges that we track, the New York Stock Exchange and the S&P 500. We've covered a lot of information today, so I want to just quickly again recap. Real estate is not just like saying it's a single sector. It's like saying it's the S&P 500. It is a broad market that has lots of different opportunities. Anywhere from taking $1 million that you have burning a hole in your pocket and buying an office building and then renting out that office building, plus the option to be able to go in and invest in an ETF that then does all of the work for you. Regardless of what you choose, there is lots of opportunity in real estate, regardless of how the market is doing. Real estate is not correlated to the market. So just because the market's doing poorly doesn't mean that real estate is doing poorly. It could be that real estate is doing very well when the market's doing poorly, or the market's doing great and real estate's doing great. So all of that is viable options. Then, did I miss something?
HV said I signed in a bit late. Can you repeat what you said about the coupon?
Yes, I can, HV. I'll show you in a second here. So again, REITs are not just ETFs. They're not just an equity that's traded on the New York Stock Exchange or on the S&P 500 or the NASDAQ. It is a broad category and a market unto itself that performs well regardless of how the market is doing. It is an industry that carries an immense amount of risk, but also has a lot of opportunity for reward. So it is as important, if not more important, to always do your research and trust and verify everything. Sorry, trust but verify everything. Someone is asking, how do I get my coupon? So if we come over here to the website, what I did was I went up to the top to log in and clicked existing user sign in here. I hid that part because, my login info. But you can click right here in SMS App Launch Promotion. Click here to learn more, and clicking there will give you a coupon code. I don't want to show you mine because I don't want the free tablet. However, there is a coupon code right now in chat if you're interested in. What that coupon code does for you is when you go to purchase a subscription, you enter that coupon code right there. And when you do that, it will give you $100 off your purchase, and the person whose coupon code you used, they get a free tablet. So it's a win-win for everyone involved. If you're interested in getting involved with Sectors Made Simple, there has never been a better time than right now, because the market is in an uptrend, because there is a bull market somewhere, and we help you find that bull market. If it's in real estate, in the broad market itself, or in a sector. As well as if there's ever a topic like REITs that you are interested to learn more about, you can always shoot us an email, regardless of if you're a member or not. I love getting to hear from you all what topics you want to hear more about. And webinars, just like this webinar on real estate investment trusts, is thanks to a lovely SMS subscriber who wanted to hear me talk about it. So, you know who you are. Thank you so much for your recommendation. And thank you all for joining us in today's webinar. I hope you all learned something a little bit new, as well as found some interesting resources on learning more about the real estate industry as a whole, regardless of how you get involved. Direct investment, real estate funds, ETFs, or REITs as a whole. But that's all the information I have for you all today. Thank you all for joining us. Again, any questions you have, feel free to email us at support@sectorsmadesimple.com. Members, we'll see you on Tuesday for a lovely webinar about this word that I have a lot of trouble pronouncing, non-fungible tokens, or NFTs, a very interesting way that crypto technology has been utilized in the 21st century world. All of that coming to you in Tuesday's members webinar. And for everyone else, I hope to see you back next Friday for another awesome webinar topic. thank you all so much. Have a lovely and safe weekend, and we'll talk to you all very, very soon. Take care, everyone. Bye.